Welcome to the channel. My name is Shannon Rifkin. In this week's video I'll be discussing with the title here, with Qantas ramping up for international flights by December and Gladys Berejiklian talking up international travel by Christmas. Is it finally time to jump into tourism stocks? Start as always with chart performance on a relative basis since beginning of 2020. Of course, early in the year, things were looking good until the reality of the pandemic dawned on investors, and we saw significant falls in March and April of last year. At which point, and I'll address this more, we saw some pretty significant recapitalization plans, and then, of course, as vaccinations later on in 2020 passed through clinical trials and the hopes of renewed international travel and domestic travel, we've seen this point. But right here, right at the end, of course, this new vision from some that we'll have international travel resuming fairly soon has resulted in a jump in the share prices, pretty significant one, in fact. Now, what I'm going to show you here is how these businesses actually looked in FY19, so before the pandemic hit, and their PE ratios at the time as well. So market cap for Qantas of almost $20 billion, Flight Centre $3 billion. This is revenue rather, revenues of $19 billion, $3 billion and $366 million, and also the earnings per share. And this is an important thing to consider based on what I'm about to say. And then PE ratios, pretty standard for Qantas, always around that as a cyclical business. It doesn't often get a premium, but 11 times multiple. Flight Centre a little bit higher with higher growth and probably slightly less cyclicality, and Webjet with the highest growth of the lot at 19 times. Now, so I think this is the key point to make here when looking at these share prices, which still well below where they were pre-COVID, but obviously missing a very important consideration, and that is when things were at their worst and these companies were fighting for survival, what they needed to do to survive was obviously issue significantly larger than typical levels new equity to support the extended periods of negative cash flow. Yes, there was JobKeeper that supported them. That government stimulus has continued again with these new lockdowns, but needless to say, they need to raise a lot of capital. In Qantas's case, I think they raised about 30% or 35% in equity in new shares. With Flight Centre, I think there's about 95% on top new shares, and Webjet, I think, ultimately expanded their share base by over 100%. I think they were about 130%. So compared to where we were pre-COVID, Webjet now has effectively 230% of the shares that it did prior to COVID. So this is what's incredible to consider, is that despite the fact we're nowhere near getting back to pre-COVID revenues, which will come at a point, and there's an argument certainly from some analysts out there to say that there's a lot of pent-up demand, and these businesses will actually bounce back really quickly, and you might even see increased revenue bases in a quicker than expected time frame. But this is a big difference here. You're talking about July. I think that's 2019. I apologize for that error. But of $9 billion for Qantas in roughly 2 years ago. Today we're at over $10 billion. Flight Centre is the only one that's a little bit lower, $5 billion almost, and now at almost $4 billion. And look at this one. This is crazy. Webjet of $1.84 billion a couple of years ago, and now $2.31 billion. Now this is on, as at today, significantly lower revenue levels. Even I think the biggest bull out there has to say that if there is going to be international travel resuming by the end of this year or early next year, it's not going to be all states. It's going to be staged. It's not going to be global. It's going to be probably to countries with low COVID rates. There'll be probably some significant dampening on demand because of things like stay-at-home quarantine orders. All these sort of things kind of make it hard to predict that we're going to see significant revenue growth in the immediate near term. Now, obviously, with the low interest rate environment, the future recovery and the pricing in future cash flows, that's probably the net present value of those future cash flows is worth more today than it would otherwise be in a higher interest rate environment. But to see share prices, I should say, down in Webjet's case, Webjet, black one here, only down about 35% from pre-pandemic levels when they have over doubled their shares on issue, shows that the forward PE ratios that these are all on right now are significantly higher than what they were, and I mean really significantly higher than what they were pre-pandemic. So in my view, despite the outlook for these companies operationally looking very bright into 2022 and 23, in my view, probably with the exception of Flight Centre, which offers at least more value, the outlook for Webjet and Qantas is questionable because that, in my view, it's been more than priced into the stocks. So I think you probably missed the boat on taking advantage of this theme, and any opportunity to buy into these would be on some weakness or perhaps in a year's time if they haven't done much. Anyway, if you like this video, please click like and subscribe, and I'll be back with a new video next week.